Okay, let's unpack this. Imagine owning a piece of the gold rush, tapping into these soaring metal prices we're seeing, but without ever needing a shovel or a pickaxe or even like a hard hat.
Right. In a world with persistent inflation and, escalating costs that can just eat away at traditional mining profits.
What if there was a different way? A business model that lets you own the gold, effectively,
Hmm.
but not the mine itself.
Exactly. And we're talking about a company that, for years now, has managed to sidestep a lot of the operational headaches that plague its peers. It delivers this really remarkable blend of, well, stability and growth.
Today, we're taking a deep dive into Royal Gold, Inc. The ticker is RGLD. We want to understand how they pull this off and really whether it makes them this resilient, profitable mining monarch for today's investor.
That's the goal. Our mission here is to explore Royal Gold's unique strategy. Is it actually a superior investment in the precious metals space? What does that mean for their financial health? And importantly, what are the risks and opportunities ahead for you, whether you're a potential investor or just curious?
And just so everyone's on the same page, all the market data and financials we'll talk about are current as of August 25, 2025.
Okay.
So a few quick facts to start. Royal Gold's share price closed at $177.44 on August 21st.
Uh-huh.
Its 52-week range is pretty wide, $130.67 up to $191.78.
Okay, so some volatility there.
Definitely. And the company has a substantial market cap, $11.68 billion.
Big player.
And they offer an annualized dividend of $1.80, which gives you a forward dividend yield of about 1.01%.
Okay, so providing some income too. Let's get into how they actually operate then.
Chapter 1, Business Analysis, the Royalty and Streaming Blueprint. So, Royal Gold. It's not a mining company like, say, Barrick or Newmont, right?
Yeah.
No giant trucks, no thousands of employees at a mine site.
Not at all. They're a royalty and streaming company. It's a very specialized financing model for the mining industry.
Okay, break that down. How does the blueprint work? What makes it so different?
Well, it's really quite clever. They act as financiers through two main ways. First, you have streams.
Streams.
Think of these like purchase agreements. Royal Gold makes a big upfront payment to a miner.
Right.
And in return, they get the right to buy a percentage of that mine's future metal output, gold, silver, whatever, at a deeply discounted fixed price. And crucially, that price is fixed for the entire life of the mine.
Wow, locked in, regardless of the miner's costs.
Exactly. A perfect example is the Mount Milligan mine. Royal Gold pays just $435 per ounce for the gold it gets from there. Doesn't matter what the mine's actual costs are, even if they go way up. And streams are significant. They were 67% of Royal Gold's revenue in 2024.
So they lock in that low price for decades.
Mhm.
That's powerful. What's the other part?
The other part is royalties. These are generally simpler deals.
Okay.
Again, usually involves an upfront payment from Royal Gold. And for that, they receive a percentage of either the revenue or the actual metal produced from a mine. Sometimes it's calculated after certain costs are deducted. Sometimes it's top-line revenue. Royalties made up the other 33% of 2024 revenue.
So streams and royalties. And this whole model provides capital to the miners.
Precisely. It's essential capital for miners, money they need for developing new projects, expanding existing ones, maybe even funding M&A. It's often capital that's, frankly, harder or more expensive for them to get through traditional bank loans or by issuing more stock.
Okay, so it sounds like Royal Gold gets that upside exposure to the metals, but without the massive capital spending and the daily grind of actually running a mine.
That's the core idea.
And they seem very deliberate about where they invest. You mentioned strategic diversification. They focus on precious metals, right? 76% gold revenue in 24.
Yeah, predominantly gold, then about 12% silver, 9% copper, and a small slice of other metals, gold-centric, definitely.
But it's the geographic and asset diversification that really jumps out.
Absolutely. Their geographic spread isn't random, it's a strategy. They balance very low-risk, stable places like Canada and the U.S.
Which were over half their revenue in 24, you said?
That's right, 35% Canada, 17% U.S.
Yeah.
And they balance that with carefully managed exposure in other regions, the Dominican Republic, Chile, Mexico, Australia, parts of Africa.
So they're not overly reliant on any one political climate.
Exactly. It diversifies away that single point of failure risk. And by asset, the portfolio is huge. Interest in around 175 properties,
Wow.
including 42 mines producing right now, and another 18 projects in development. But the real crown jewels are their principal properties.
Yes, Andocalo, Cortez, Mount Milligan, Pueblo Viejo.
Those are the big ones. And many of these are life-of-mine agreements. Think about that. It locks in cash flow for decades. Pueblo Viejo goes beyond 2040, Mount Milligan to 2036, and Royal Gold doesn't have to put in more capital for future expansions at those sites to keep getting their share.
Incredible long-term visibility. So how does Royal Gold stack up against competitors using this, well, elegant model?
They're one of the big three. It's really them, Franco-Nevada, and Wheaton Precious Metals dominating the publicly traded royalty and streaming space. Their value proposition is simple but powerful. You get leveraged exposure to rising metal prices, but with significantly lower direct risk compared to a traditional miner.
Because they're insulated from the operational stuff.
Exactly. Insulated from direct operational risks, insulated from those escalating costs miners face, yet they still benefit if the miner finds more gold or extends the mine life through exploration. It's a sweet spot.
And it seems like a pretty good time to be in that sweet spot. The market for precious metals looks strong right now. What are the key prices and drivers?
Yeah, we're definitely in a bullish backdrop for precious metals. As of, late August 2025, gold's around $3,370 an ounce. Silver's near $38.75.
Pretty high levels historically.
Very much so. And there are some big global trends pushing this. Strong investment demand, especially via ETFs. Plus, massive central bank buying.
Right, I saw that over 1,000 tons for 3 years running.
Yeah, it's significant. Driven by geopolitical uncertainty, countries wanting to diversify away from the US dollar. Some analysts are even calling for gold to hit $3,600, maybe even $3,675 near term.
Wow. And supply demand.
Gold demand is robust. Silver actually has a structural deficit. Industrial demand for solar panels, EVs, is just soaring.
Meanwhile, the traditional miners, their partners, are facing challenges.
They are. Rising costs for energy, labor, plus increasing ESG pressures, carbon taxes, stricter environmental rules, all that impacts their bottom line.
Which Royal Gold largely avoids. That insulation, that royalty moat you mentioned, sounds like their core competitive advantage.
Yeah.
Especially the capital light part.
It's huge. That capital light structure creates a deep, durable moat. It's very hard to replicate. Think about this efficiency. 30 employees. 30 employees generating over $719 million in revenue last year. Compare that to a traditional miner needing thousands of people for similar revenue. The productivity difference is staggering.
Orders of magnitude higher.
Exactly. And that lean structure leads directly to those exceptionally high, stable profit margins we'll get into. And here's a fascinating part. It's a built-in inflation hedge.
How so?
Well, miners' costs go up with inflation, right? Energy, labor, supplies. But Royal Gold's ongoing costs, like that $435 per ounce for Mount Milligan gold, are fixed by contract.
Ah, so when inflation pushes metal prices up.
Royal Gold's revenue goes up, but their cost for that metal stays the same. Their margins actually expand. It's beautiful.
That is clever. Plus their portfolio quality.
Yes, that portfolio of long-life, high-quality assets like the Cortez complex.
Ooh.
That's an irreplaceable advantage built over years. And one last thing, they don't hedge.
No hedging.
Nope. They provide direct exposure. They sell the metals they receive at whatever the spot price is, so investors get the full upside if prices run.
Chapter 2. Management evaluation. The financier's touch. Okay, a unique model like this. Its success has got to be tied to the leadership, right?
Yeah.
Who's steering the ship at Royal Gold?
Absolutely critical, and Royal Gold's leadership team is, well, perfectly suited for this specific business. The president and CEO is William Heisenbuttel. He and the whole team have deep backgrounds, not in digging stuff out of the ground, but in corporate finance, banking, law, specifically within metals and mining finance.
So they're financiers first, miners second.
You could say that. They are financiers with a deep understanding of mining. Their real expertise is financial engineering, shrewd capital allocation, risk assessment, complex deal-making. Those are exactly the skills you need to structure these multi-decade, often very complex stream and royalty agreements effectively.
Makes perfect sense for their model. And it sounds like their approach to capital allocation is equally disciplined and strategic, focused on shareholder value.
Very much so. Management consistently emphasizes capital discipline. They aim to grow the portfolio primarily using their own cash flow, and they use debt very conservatively. Why? To limit shareholder dilution. They try hard not to issue tons of new stock that waters down existing shareholders' ownership.
Smart. And the M&A strategy reflects this.
Definitely. The company's whole history is a strategic pivot away from capital-intensive mining towards this high-margin royalty model. They've made key acquisitions over time: International Royalty Company back in 2010, Great Bear Royalties more recently in 2022. These deals let them grow their asset base without taking on the operational risks.
And speaking of deals, They just announced a massive one, right? Acquiring Sandstorm Gold and Horizon Copper, about $3.7 billion.
Yeah, that's a huge, potentially transformative transaction. It's set to significantly boost Royal Gold's scale, its diversification across different assets and regions, and its future growth profile. A really big step.
And alongside these growth moves, they're known for returning capital too, that dividend track record.
It's extraordinary. 24 consecutive years of increasing the annual dividend. 24.
Wow.
They are literally the only precious metals company in the S&P High Yield Dividend Aristocrats Index. That tells you something.
It really does.
For 2025, they just announced another big hike, 12.5%. Their priority seems to be reinvesting in good, accretive deals that add to earnings per share right away, and growing that dividend steadily. They don't focus much on share buybacks.
That speaks volumes about their confidence in future cash flow. And does their return on invested capital back this up?
It does. Their ROIC was an impressive 19.71% for 2024. The trailing 12-month figure is around 10.18%. It consistently shows they're deploying capital very effectively and generating strong returns on it.
Chapter 3. Financial Analysis of Fortress Balance Sheet.
Oh,
All right, let's get into the nitty-gritty numbers. Does Royal Gold's financial health actually stack up? Does it match this compelling business model and smart management?
yeah, diving into the financials really confirms the story. You see strong growth, exceptional profitability, and really robust cash flow. We mentioned the market cap, around $11.68 billion as of late August 25.
Right.
Revenue growth has been impressive. It climbed from about $561 million back in 2020 to a record $719 million in 2024. And the trailing 12-month revenue is even higher, almost $792 million, thanks largely to those strong commodity prices we talked about.
But the margins are the real standout, aren't they?
Absolutely extraordinary. It's the direct result of that capital-light model. Their adjusted EBITDA margin in 2024 was 81%.
81%.
81. That's earnings before interest, taxes, depreciation, amortization, basically core operational profitability. It's just incredibly high compared to almost any industry, let alone mining.
Unbelievable. And net profit margin.
Also remarkable, the trailing 12-month net profit margin is sitting at 56.8%. Just think about that. Over half of every revenue dollar drops to the bottom line.
That's incredible efficiency. And that fuels cash flow.
Directly. Strong and growing operating cash flow. It went from $385 million in 2020 up to a record $529 million in 2024. And that cash flow is what funds everything, those strategic acquisitions and, of course, that steadily growing dividend.
Those margins are just, wow, almost like a software company,
Yeah.
but backed by real assets. Sounds like they genuinely have a fortress balance sheet, too.
Fortress is a good word for it. They have an exceptionally strong financial position, minimal debt, lots of liquidity, consistent growing earnings. It gives them tremendous flexibility.
Minimal debt. How low are we talking?
As of the end of 2024, their debt-to-equity ratio was just 0.083. That's only 8.3%. Super conservative.
Very low leverage.
And their current ratio, which measures short-term liquidity, was very healthy at 3.23, meaning they have over 3 times the current assets needed to cover their short-term bills. No liquidity concerns there.
Rock solid.
And again, that 24-year streak of dividend growth, it's just the ultimate proof of management's confidence in the long-term sustainability and predictability of these cash flows.
Okay, so fortress balance sheet, incredible margins, consistent growth. Given all that strength, let's talk valuation analysis. What's a fair price for a company like this?
Right. Valuation always requires looking at it a few ways. First, relative valuation, comparing it to peers in the industry.
Okay.
If you look at its price to earnings ratio, the PE, on a trailing 12-month basis, it's around 26.0x.
How does that compare?
It's a bit higher than the peer average, which is around 22.2x, and the broader industry average of 23.3x. This suggests the market is already giving it a premium, likely for its quality, its stability, and that lower risk profile we discussed.
Okay, a quality premium makes sense. What about price to cash flow?
Price to cash flow, or PCF, is around 20.6x trailing 12 months. Again, that's significantly higher than some of the big mining producers. But you can argue it's justified by the sheer stability and predictability of these royalty and stream cash flows compared to mining operations. It consistently trades at a premium to peers like Franco-Nevada and Wheaton on these metrics.
So relative to others, it looks premium priced, but maybe justifiably so. What about intrinsic value? What's the company actually worth based on its own fundamentals?
That's where things get interesting. For intrinsic and sector-specific valuation, analysts often use discounted cash flow or DCF models. They project future cash flows and discount them back to today.
And what do those models say?
Well, there's always a range, but analyst DCF estimates for Royal Gold put its fair value somewhere between, say, $201 on the conservative side, up to maybe $330 per share on the more optimistic end.
Okay, and the current price is around $177.
Exactly. So even the low end of the DCF range suggests the stock might be trading at a discount to its intrinsic value right now.
Interesting. Any other key metrics for this sector?
Yes, price to net asset value, or P/NAV, is really important in mining and royalties. It compares the market price to the underlying value of the assets. Typically, high-quality royalty companies like Royal Gold trade at a premium to their NAV, often in the 1.3x to 2.0x range.
And Royal Gold likely fits that.
We don't have a specific P/NAV number readily available, but given its premium on other metrics like PE and PCF, it's highly likely it commands a similar premium PAV, confirming its high-quality status in the market's eyes.
Chapter 4. Market sentiment, what the pros are saying. Okay, so the business model looks strong, financials are impressive, maybe even undervalued intrinsically. What's the general feeling on Wall Street? What are the pros saying about Royal Gold right now?
Well, the overall market perception, judging by analysts, is broadly positive. It reflects that confidence in the business model, the growth outlook, especially with the Sandstorm Horizon deal, and of course, the strong commodity price environment.
And what are their price targets looking like?
The consensus 12-month price target, that's the average from analysts covering the stock, is around $209 per share, though there's a range naturally from about $166 on the low end to $237 on the high end.
So $209 consensus.
Yeah.
Compared to the current $177 seller price, that implies decent upside potential, around 17–18%.
Exactly, about 17.8% upside potential based on that consensus target. And the overall rating tends to be buy or moderate buy. A solid majority recommend either strong buy or buy.
Have they reported earnings recently? How did that go?
They did. Q2 2025 earnings came out August 6th, and they were strong. They beat expectations. EPS came in at $1.81, beating the $1.70 an estimate. Revenue was $209.6 million, also nicely ahead of the $186.6 million forecast.
Good beats. And looking ahead,
Analysts are projecting EPS of around $2.15 for the current quarter, so they expect the strong performance to continue.
okay, analysts are positive. What about other market indicators? Things that gauge the broader investor mood, maybe potential short-term stock movements?
We can look at a couple of things. First, short interest. This measures how many shares are being borrowed and sold short by traders betting the price will fall.
Right. What's that look like for RGLD?
It's at a moderate level, somewhere between 3.42% and 5.11% of the float, depending on the source.
How did that compare to peers?
It's actually higher than the peer average, which is closer to 2.5%.
Interesting. So, more traders betting against it than its peers. Why might that be?
The most likely reason is probably those large pending acquisitions of Sandstorm and Horizon. Some traders might be concerned about the integration risk or the price paid or maybe just the overall complexity.
Okay, so some skepticism there. But what about the stock's technical picture? Price trends?
That tells a more bullish story right now. Looking at the price versus its moving averages, the stock is in a healthy uptrend. The current price, around $177, is comfortably above both its 50-day moving average, which is near $167, and its 200-day moving average, around $158.50.
So technically it looks strong despite the elevated short interest. What does that combination mean?
Well, it can create an interesting dynamic. You have a stock in a technical uptrend, but also a decent number of people betting against it. This setup could create conditions for a short squeeze.
Ah, where good news forces the short sellers to buy back shares quickly.
Exactly. If some positive catalyst emerges, maybe related to the acquisitions or even stronger metal prices, those short sellers might rush to cover their positions, meaning they have to buy shares back. That buying pressure can accelerate the price increase rapidly. It creates a potentially asymmetric risk-reward. The upside could be amplified if a squeeze happens.
Chapter 5. Ownership structure, who's holding the reins. That short squeeze potential is fascinating. So let's look at who actually owns Royal Gold. Is the smart money heavily involved here? Does that give us any clues?
Yeah, the stakeholder analysis is quite telling, and the answer is yes, the smart money is definitely present. Institutional investors, think big mutual funds, pension funds, asset managers, hold a commanding majority of the shares, somewhere between 87% and 89% of the outstanding stock.
Wow, nearly 90%. That signals pretty strong confidence from professional managers, doesn't it?
It really does. It suggests they believe in the long-term story, the business model, the management.
Who are some of the big names holding it?
The top shareholders include giants like Capital Research and Management, holding about 13.6%. The Vanguard Group has around 10.0%, and BlackRock holds about 8.3%. In fact, if you look at just the top 7 institutional investors, they own more than half the entire company.
Okay, so institutions are big believers. What about insiders, directors, executives?
That's the flip side. Insider ownership is actually very low, less than 1%.
Less than 1%. Is that unusual?
It's not totally uncommon for a large, mature company like this where founders might be long gone and stock options make up a lot of executive compensation. However, it is a data point worth noting. And looking at recent insider trading activity,
What does that show?
over the last 12 months, there have been significantly more sales by insiders than purchases. And importantly, there haven't been any open market buys by insiders in the last 3 months.
So insiders aren't actively buying more shares at these prices.
Correct. Now, this doesn't automatically mean they lack conviction. Sales could be for perfectly normal reasons like financial planning or diversifying assets. But the lack of recent open market buys doesn't exactly signal strong insider belief that the stock is deeply undervalued right now. It's just something to be aware of.
Chapter 6, Risk Assessment, Navigating the Global Chessboard. Okay, makes sense. Every investment carries risk, of course. Even a company with a strong model like Royal Gold isn't immune. Let's unpack the potential challenges, the vulnerabilities here.
Absolutely crucial to look at the risks. While the royalty streaming model is inherently lower risk than mining, it's not no risk. A key weakness, maybe the most obvious one, is that direct revenue dependence on volatile commodity prices.
Right. If gold or silver prices tank.
Their revenue tanks too. Unlike a miner who might be able to cut costs or hedge production, Royal Gold's top line is almost purely a function of metal prices. They don't operate the mines, so they also rely heavily on those third-party operators doing a good job. Production hiccups at a key mine can impact them.
And low insider ownership could be seen as a minor weakness too. What about opportunities?
Big opportunities. The successful accretive integration of that huge Sandstorm and Horizon acquisition is number one. That could really boost growth. Continued strength in the precious metals bull market is obviously a major tailwind. And potentially increasing demand for base metals like copper, which they have some exposure to, driven by the global energy transition.
Okay, strengths, weaknesses, opportunities,
Yeah.
and threats.
Threats definitely exist. Geopolitical risk or resource nationalism in the countries where their assets are located, adverse changes to tax laws or royalty regimes by governments.
We saw some of that chatter in Chile recently. Right.
Exactly. A sharp global economic downturn that hammers metal prices would be a major threat. And potentially things like trade disruptions, say, those U.S. tariffs on imported gold that have been discussed could create volatility.
So let's dig into that geopolitical and regulatory risk. How does Royal Gold manage operating across this global chessboard with assets in so many different places?
Their portfolio construction is key here. It's deliberately structured to diversify and manage these global risks. They aren't overly exposed to any single jurisdiction.
Give us some examples.
Okay, Canada makes up 35% of 2024 revenue. That's considered a very low-risk jurisdiction. Stable politics, clear mining laws.
Makes sense.
The U.S. is 17%, also very stable. Then you have the Dominican Republic at 12%. That's viewed as having moderate risk, maybe some concerns about corruption or bureaucracy, but generally manageable.
And Chile, that was 7%.
Right. Chile is seen as having somewhat elevated risk currently due to those new higher mining royalties that were implemented, plus some political shifts, although recent legislation there aims to streamline permitting, which could be a positive.
So the diversification really is the strategy.
It is. It creates a much more balanced and resilient global footprint compared to a company with all its eggs in one potentially risky basket.
Beyond specific countries, what about broader macroeconomic and specific threats? You mentioned commodity prices.
Yeah, that raises the most important question, really. As a non-operating entity, their revenue is almost entirely driven by metal prices. Commodity price volatility is the single biggest external threat. A sharp, sustained downturn in gold, silver, or copper prices would hit their financials directly and significantly. No way around that.
What about those trade issues, like potential U.S. tariffs on gold?
Things like protectionism or trade disputes. Well, they wouldn't impact Royal Gold directly like a producer importing doré bars, but they could absolutely create market volatility, mess with supply chains, and indirectly hurt their operating partners, which could eventually flow through.
And ESG regulations? They don't mind, so are they immune?
Not entirely. While Royal Gold's own direct carbon footprint is tiny, stricter ESG-related regulations, especially things like carbon taxes or tougher environmental rules, definitely increase the cost burden on their operating partners.
Ah, the miners actually running the projects.
Exactly. If regulations make a partner's mine uneconomic or significantly more expensive to run, that could potentially affect the long-term viability or profitability of the asset that Royal Gold has a stream or royalty on. So it's an indirect but still relevant risk.
Chapter 7. Conclusion of the Monarch. The Mining Monarch's Future. Okay, we've covered a lot of ground. The unique business model, the financials, management, market view, risks. So let's try to bring it all together. What does this mean for you, the listener? Let's look at the bull case and the bear case.
Right, let's synthesize. If we connect all of these threads, the bull case for Royal Gold is really built on that superior business model. You get leveraged exposure to precious metals, especially gold, but with significant insulation from those traditional mining risks and, crucially, from inflationary cost pressures.
The capital-light, high-margin advantage.
Exactly. Add to that the fortress balance sheet, the world-class diversified portfolio of long-life assets, and a management team with a proven track record of disciplined capital allocation.
And that incredible 24-year dividend growth streak.
You can't ignore that. Plus, the pending Sandstorm Gold and Horizon Copper acquisitions look poised to significantly boost their scale, diversification, and future growth potential. It really could solidify their position as a mining monarch.
Okay, that's a compelling bull case. But there's always another side. What are the core arguments for the bear case? Why might someone be cautious?
Well, the risks are real, even if they're managed. First and foremost, the company's fortunes are undeniably tied to volatile commodity prices. A bear market in metals would hurt them.
No escaping that.
Geopolitical risk in some of their operating jurisdictions remains a concern, that potential resource nationalism or unexpected tax hikes.
Right.
There's also execution risk with those big Sandstorm and Horizon deals. Integrating acquisitions of that size smoothly is never guaranteed.
True, complex integrations can stumble.
And finally, that premium valuation we talked about. On metrics like PE and PCF, it trades higher than many peers. You could argue that a lot of the good news and the quality is already reflected or priced in to the stock.
So maybe less room for upside if everything just goes as expected. How does the valuation picture look overall when you weigh the intrinsic value estimates against the current price?
It's an interesting balance. Despite that premium quality, the current share price, around $177 as of late August 25, still appears to be trading at a noticeable discount to those analyst intrinsic value estimates.
The DCF model's putting fair value between $201 and $330.
Correct. Even the low end of that range is well above the current price. And the Wall Street consensus 12-month price target of $209 also suggests modest undervaluation and potential for capital appreciation from here.
So wrapping up, Royal Gold seems like a high-quality, definitely lower-risk way to get exposure to the precious metal sector compared to traditional miners. The unique model, strong financials, disciplined management, it creates a pretty resilient company.
I think that's a fair summary.
Let's maybe sketch out a few potential scenarios for you to consider. A base case, perhaps.
Okay, base case. Let's say metal prices stay roughly where they are now. Maybe gold bounces around $3,500 an ounce. And let's assume the Sandstorm Horizon integration goes reasonably smoothly. Outcome. In that scenario, you'd likely see the stock price gradually appreciate towards that analyst consensus target, maybe somewhere around the $209 mark. Steady, moderate gains.
Okay, now the optimistic view, the bull case.
Bull case. So the metals bull market continues. Maybe gold pushes decisively above $3,600. And the M&A integration proves highly synergistic, exceeding expectations. Outcome. Here, the stock could move towards the higher end of analyst targets, maybe $237 or so, and potentially even challenge the upper end of some of those DCF ranges, perhaps pushing past $250 over time. Significant upside.
And finally, the downside, the bear case.
Bear case. This could be triggered by a few things. Maybe a global recession hits, or a major shift in monetary policy sends gold tumbling back below $3,000 an ounce, or significant geopolitical instability flares up at one of their key principal assets, or maybe those big M&A deals hit major integration snags. Outcome. In that situation, the stock could face a pretty significant sell-off, potentially retesting those 52-week lows we saw down around the $131 level. Real downside risk is there.
This whole discussion really raises a fascinating final thought. If a company like Royal Gold can so effectively abstract away the dirt, the grime, the operational complexity of actual mining,
Mm-hmm.
and still deliver these stable, high-margin returns tied to the commodity,
Yeah.
what does that tell us about the future of investing in other capital-intensive industries? Is this kind of capital-light financing model the ultimate evolution? Something to ponder.
It's a great question about where value creation lies.
Well, we certainly hope this deep dive into Royal Gold Inc. has sparked some new insights for you. If you found this valuable, please do like and subscribe to the 1 Trillion Ounce YouTube channel. We cover all kinds of mining companies there, and we definitely take requests for specific stocks you'd like us to look into in the precious metal space. We love hearing your thoughts and what you want us to unpack next.
Yeah, let us know in the comments.
And just the usual reminders. Please remember, this analysis was generated by an AI system, primarily for educational and informational purposes. It should absolutely not be considered financial advice.
Definitely not.
Please always conduct your own thorough research, consider your own financial situation, and consult with a qualified financial advisor before making any investment decisions.
And this deep dive was built upon expensive research, but its analysis, structure, and the way we presented it were assisted by AI to help synthesize that information and bring you the most digestible insights from all the source material we reviewed.